I am Umesh Rana, the F8 Audit Assurance lecturer at Griffith College. Today I'm going to give you an overview of audit risk. On every audit, the concept of audit risk exists. In fact, the international standards on auditing are all risk-based standards. The entire audit process is a risk-based process. The importance is fairly obvious that the auditor will identify potential misstatements, likely potential misstatements in the financial statements, by performing risk assessment procedures as required by ACCA 315. Once we've identified these potential misstatements, then we will address them, i.e., by designing suitable audit procedures. Having designed suitable audit procedures and having performed those procedures, we will then discover errors or likely misstatements if they exist. Having discovered misstatements, we will then obviously give an opinion which will be the correct opinion, and it will minimize the risk of giving an incorrect opinion. And in this manner, it will also help us to carry out a cost-efficient audit, gathering all the evidence that we need in an audit to be able to express an opinion. So, continuing on, audit risk is the risk that the auditor expresses an incorrect opinion. In other words, he gives an opinion which states that the financial statements give a true and fair view, when in fact they don't. On every audit, this concept of audit risk exists. Audit risk can never be eliminated. All it can be done to that is to be minimized. The only way you can actually get rid of audit risk completely is by examining every single transaction, which would make the cost of an audit prohibitive, and the benefit of an audit would be far exceeded. The cost of an audit would be far exceeded by the benefit. Audit risk has three individual components which have to be addressed by the auditor. The first one here is inherent risk. Inherent risk is the risk of errors or misstatements that are likely to occur in the financial statements, and they could occur because of the nature of the business of the entity or of its transactions. The auditor does not consider the internal controls at this stage at all. Inherent risk must be considered at the entity level and at the individual account balances and transactions level. For example, at the entity level, a company like BP Oil involved in exploration, the inherent risk would be very high. As you could see from the Gulf offshore platform disaster, which has resulted in major fines and penalties and had a very significant impact on their financial statements. So the nature of the business will also determine the level of inherent risk. You could also have, for example, poor trading results or a company in a volatile industry. For example, you can have a computer games company. The company can pump in a lot of money into computer games, designing them, and they could turn out to be a flop, which could in effect affect going concern of the company as well. The complexity of transactions. Oil companies tend to have fairly complex transactions. The more complex the transaction is, the greater the likelihood of a misstatement. It's not a guarantee of a misstatement, but there is a greater likelihood. We then come down to inherent risk at the account level and the assertions which underline balances. Certain balances in the financial statements are more likely to be misstated. For example, if you take non-current assets, there's a greater likelihood of misstatement there because of depreciation. Depreciation is an estimate. Estimates can vary and estimates might be wrong. Therefore, there's a greater likelihood that non-current assets can be misstated. Take another example. You can have payables. Payables could be misstated for the simple reason if all the payables haven't been recorded, i.e. the completeness assertion underlying payables, then payables could be understated. So therefore, payables, there's a greater likelihood of misstatement, and the assertion most likely to be misstated is completeness. We then move on to the second component of audit risk, which is control risk. Control risk is the risk that a misstatement could occur in an account balance or class of transactions that are not prevented from occurring because of a poor control system. So in other words, if the controls are poor in an entity, there is a greater likelihood of misstatements occurring. Conversely, if you have an internal controls system in an entity which is very strong, there is a lesser likelihood of misstatements occurring, because the very nature of an internal control is to prevent, detect, and correct misstatements. Examples of control risk. Directors' lack of awareness of the importance of controls. That will increase control risk. If there's lack of physical controls, for example, cash is not kept locked overnight in a safe, cash can be easily misappropriated. That will increase control risk. Lack of authorization. Authorization controls. Anybody can authorize goods for purchase. Those goods may not be for business use. They might be not needed by the company. And on the last example, segregation of duties. If one person does a lot of different things within an entity, there is a greater risk of misstatements occurring because of possible fraud. The first two risks that I've just talked about, inherent in control, are both referred to as entity risks because they belong to the entity. The auditor assesses those two risks. The third risk we have, also a component of audit risk, is called detection risk. Detection risk is defined as the risk that the auditor's substantive procedures that he performs will not detect misstatements in the financial statements. Therefore, if the auditor wants to keep his detection risk low, that means he wants to be more confident that his procedures will detect misstatements, then he's going to have to do more substantive procedures by doing or obtaining bigger sample sizes. Bear in mind that detection risk is the only risk that the auditor can manage. And the relationship between these three components is shown and illustrated on this slide. Supposing the auditor sets his audit risk as 5%, which is the maximum risk that he is prepared to accept on this audit, he will assess inherent risk and control risk. In this example, I have kept inherent risk at high, 90%. Control risk is 30%, which means the controls are relatively strong and effective. Therefore, detection risk is calculated at approximately 18.5%, which means the auditor needs to be at least 81.5% confident that his substantive procedures will detect misstatements. By using the audit risk model, it prevents the auditor from obtaining too much of evidence or too little. In other words, over-auditing or under-auditing. So the summary of the audit risk model: the auditor will assess inherent risks that are faced by the business, both at the entity and the financial statement level. He will then look for controls which will address these risks. If he finds there are controls that are existent in that entity and they are strong enough on paper, he will then perform tests of control and he will test those controls. Assuming that those controls are satisfactory, the indication now is that the misstatements or likelihood of misstatements will be reduced in the financial statements because of strong controls. That will then drive the amount of audit evidence that the auditor will need in terms of detection risk. And that gives you an overview of the audit risk model. I will be covering this in more detail with more practical applications in practice, and I hope to see you in class then.